Good day. I hope we are all fine. Today we are back here, and this is Raquel Media as usual. And today we'll be diving into monetary theory. Let me quickly continue my episode on monetary theory. All right. So far in the previous session, we spoke about the intro to the monetary theory course and what we should be expecting and what it entails. Now, in today's session, we are going to dive into what money is, right? Let me share it. Well, yeah, I was not responding. Sharp. All right. So in today's session, we are going to talk about what money is, right? So someone will ask, what is money? In the layman terms or in economics terms, we say that money is anything that is generally accepted for payments for goods and services. So what we actually use to pay for goods and services and also to pay for debt, right? So that is what monetary theory is telling us, or that's what in economics, that's what we understand by what money is, right? Anything that is generally accepted for the payment of goods and services and also for repayment of debt. So in, oh, what's happening here? I don't like it this way. To still be like that. All right. So now what we should look out for here is to describe what money is, to understand the evolution, nature, and functions of money, to identify the types of payment systems, and also to measure money. Now, our main aim for monetary theory is more or less like how the government should control the amount of money circulating in the system, right? So that is why we are also learning this particular topic, right? To know whether government should increase a type of money or a form of money, which is M1 or M2. So the M1 consists of money that are very liquid in nature, that can be used easily, that can be used to purchase stuffs easily, right? So the M1 will constitute a type of money that can be used easily. So that is what is happening, right? So that's what we are going to now. Let's move on to the actual outcome. So now the thing is that if government wants to promote like growth in the economy, if the government wants the economy to actually boost through growth and the like, what they normally do is they increase the money supply in the system, right? So that people can take money and then invest, not actually investing, but build businesses and the likes, right? And that is M1. But if government wants to reduce the amount of money in circulation, the government actually puts in M2, like increases M2 more so that the banks will have more money and hence less M1 will be circulating the system. So the introduction to money and the barter system. So we have when during the barter system, we're having some problem with how we can even measure uh the value of goods and services we are going to exchange. So during the barter system, what they do was they were actually exchanging goods for goods and services for services, right? Now, the problem was how you are going to measure these goods and services. So let's say you have, let's say you have a car. Let's say you have a car. Now, the problem you'll be facing is how will you even measure the value of this car to exchange for, let's say, another car or something, right? So that is one of the problems for the barter system. The visibility was very difficult. Sorry. Measure how we are going to measure our goods and services was very difficult. And also durability was also a problem. So concerning of goods and services, for example, if you are going to use tomatoes to purchase another kind of good, maybe it will not like it will not be there for a very long time. Then you see the tomatoes to be uh deteriorating, Gibab. Huh. So that's also part. And then there was also a problem of portability. Sometimes maybe mazes were to be used to exchange and other stuff. And you know, maize is also heavy and the likes, right? It's heavy. So you would need to become a body man to carry this kind of maize around to go and exchange it for what you want, right? Now, talking about the visibility as well, we will not be able to, let's say, what the person wants is just a half bag of maize, right? And not a full maize. How will you be even able to divide it and the like, right? So difficult in exchanging a fraction of a live cow for a cup of salt as well is here. And also there was a problem of acceptability and recognizability in the sense that a commodity had to be recognized before being accepted. People have to recognize that this is a maize, this is something that is important before they accept it. And there was also a problem of making deferred payments in the sense that whatever you want, it means you have to pay it now, you have to exchange it now, instead of paying it later, right? So this is where money comes. So introduction, these problems led to multiple pricing for single commodity. So a single commodity, this person will be having different kind. Maybe for this one, you bring 4 bags of rice. For this person, you bring 2 bags of maize and the likes for the same commodity. So it was different. This called for a single commodity that could be used as a common denominator to overcome the problem of direct commodity exchange. Hence, that is when the introduction of money came in. So the people who brought in this concept are super smart. Now, as I made mention earlier, that money is anything that is generally accepted as payment for goods or services and also repayment of debt. So you could see that the problems we're facing up there, money is here to solve those problems. So a rather broad definition is more or less like when we think about money, sometimes we say that money is the only currency we have or something. But no, money consists of currencies, checks, savings accounts, momo, and the like. So anything that is called money and casa is important. That's why people love money. So once there is money, normally we say there is love. All right. So some of the confusions we sometimes have in our mind is, hey, Jeff Bezos was cow. Hey, Elon Musk has money and the likes. But money is different from wealth. When we say wealth, it's a summation of all the assets that person have, and not only the money aspect, right? So this assets could include either it could include fixed or tangible assets and intangible assets. So those are like in it consists of all those things, right? So now income is more or less like a flow concept here. The reason here is because income comes in and out, right? Income, I say income comes in and out. Income comes in as a result of you earning or working for something. That's why flow of earnings per unit of a time. So income can be per time, like per month, per week, and the likes, right? Okay, but more like money is a stock concept is because it is stable. It is like something that you are having at a point in time. All right. So we move on to the functions of money. So we have three main functions of money. So the main functions of money is as a medium of exchange, a unit of account, and then a store of value. So when we say money is serving as a medium of exchange, what it means is that it is used to purchase goods and services or pay for goods and services. And this has actually reduced the problems we're facing in the barter system. So we were facing some of the problems of we not being able to exchange something for something because you have to have a double coincidence of wants in the sense that the person that you are going to exchange your goods to must also need what you want. So if you want something and the person doesn't want it, then that transaction wouldn't succeed, right? Money came in to solve that problem because everyone basically needs money or wants money. So if someone is buying your item and paying with money, you are willing and happy to accept it. So that's why we are saying that it eliminates the trouble of finding a double coincidence of needs. It also promotes specialization as well. Now, for money to be a medium of exchange, what it means is that it must be easily standardized and also it should be widely accepted. It should be divisible. You remember that in the barter trade, we explained that the items weren't easily to be divided, right? They weren't, you can't divide them easily, right? It should be easy to be carried around. Unlike the barter trade where the barter system where you have to carry a heavy load of something. You get it here. You have to, money can be divisible. You can break it down to smaller denominations. And also here, money is not, the money that we normally use in transactions doesn't really deteriorate quickly, right? But unlike the barter system, the goods and service, the goods, for example, or the commodities were actually deteriorating quick. Now, another function here is more or less like is a unit of account. So when we say unit of account, what it means is that money is used to measure the value of goods. So that's why we can say that we can see that when you go to a shop and you want to buy something, it is being measured with the value of money. Like this is 2 cedi, this is 3 cedi, this is 4 cedi, and the like, right? Unlike the barter system where one same commodity, maybe you would want one cow for it, you would want one bag of rice for it, you want this for it. It was priced differently, but here, money came in to solve that problem by letting us know that this is 2 cedi and 2 cedi is 2 cedi everywhere, right? And it has also reduced the transaction cost. Transaction cost in the sense that initially you would have to look for someone who needs your item and then it would take a lot of time for you to find that person, right? But here, money, everyone wants money, so it has reduced that kind of transaction cost. And the last major function of money is a store of value. Now, when we say a store of value, what it means is that it actually maintains the purchasing power over time and not a very long time, right? So we use money to save our purchasing power over time, and also other assets serve as this function, right? So now, when we want to maintain the purchasing power of our money, we can have bonds and treasury bills and the like. But why do we say, or why do we still hold money? The reason is because money is liquid. As compared to bonds, you have to come and then convert it into money again. But money is already liquid. That's why money being a store of value is okay. So money actually maintains a store of value when we are in a low inflation system. So when the inflation rate is low, then the store of value is actually okay. But when the inflation rate is high, it actually have some effect on the store of value kind of situation. Now, Another function, which is not a main function, is more or less like a standard for deferred payments. And this actually happens when the store of value actually stands, right? So the standard for deferred payments is more or less like repaying something later. You buy something and then pay later. Now, for an item to become money, it should have these characteristics. It should be scarce. It should not be easily to come by. You can't just wake up and then get money. It should be durable as well. It shouldn't be destroyed quickly or easily. It should be divisible. You should be able to divide them into smaller denominations. It should be recognized worldwide, or it should be easily recognized by a large group of people. Because if money is not recognized by a large group of people, what it means is that they will not accept it. So looking or taking back to the barter system, if you have a good which is not recognized, what it means is that they will not accept it, right? Like for example, if Muslim doesn't really take or recognize pork as a value, but you recognize pork as a value, you cannot or you will not be able to do transaction using that pork with them, right? And it should also be generally acceptable. It should be portable, which is easily to be carried around, more or less like the barter system where you have to become a macho before you carry some goods around. It should be liquid in the form, in the sense that it should be easily converted into cash. It should be easily like it should be somehow easy to be used for transactions, right? And then it shouldn't have any intrinsic value in the sense that it should not money having like 2 cedi money should be 2 cedi and it shouldn't be more or less having an like an extra value. Yeah. Now we move on to the evolution of the payment system. So initially during the barter system, we normally use commodities like precious metals and other goods and services to um, make payments, right? Now, that was the commodity money time. Now, these precious metals were heavy and they were risky as well, right? They were heavy and they were risky as well. So we move on to the fiat money, which is the paper money, which the fiat money is more or less like what we are using, the CDs and those kind of stuff, which have a legal backings by the government, right? Now, these commodities are being able to be carried around. It is less heavy, right? But initially, when Ghana CD was CDs, it was heavy because you will need plenty money. Like you'll be walking around with plenty money. But when it was reduced to Ghanaian CDs, it's now able to be carried around easily. Now, there came in checks where you have a money in the bank and then you have to write you write something to instruct the bank to make payments on your behalf. Now there came in also electronic payments like online bill pays and those kind of stuff. And now we have e-money like Momo and debit card and the likes. So this has been the evolution of this of payment system that we've been facing or we've been having for a while now. Now, question here is, are we heading to a cashless society? Yes, we can move to a cashless society, but the problem here is that there are some kind of impediments, like something is causing us to move away, or it's not helping us to get into this cashless society, in the sense that people actually still want to hold money. When you have money in your account and it's just figures, you don't feel it. You want to hold money to see, say, oh, me woska. You get it? So there's also a portion of illiteracy rate where most people don't even know about this cashless kind of system. Some, when you go to some villages, some even don't know about Momo and the likes, right? Some even don't have access to electricity, talk less of Momo. And we also have some kind of insecurity because even those who are even using the Momo are afraid, right? They are afraid because fraudsters will call them and then lie to them and then take out their money from their account. So it's making people afraid to use this cashless kind of money. Now, another part of it is also that the cashless society looks more of a bit expensive, in the sense that small firms are not able to implement this cashless system because you need a lot of systems to make sure that everything is functioning well and is secured, right? So predictions of a cashless society have been around for decades, but they have not come into fruition. Like, they are not really happening. Although e-money might be more convenient, efficient than payment system based on paper, several factors work against the disappearance of the paper system. That's what I've mentioned, which is some of the insecurity, illiteracy, and the cost. And also, some would also want to hold money and then feel it. However, the use of e-money will likely still increase in the future. Yes, as time goes on and the security, the insecureness reduces, and also the literacy rate reduces, people are going to use more of it. Now, why will Bitcoin become the money of the future? For this question, I doubt. The reason is because Bitcoin is actually volatile. The value of Bitcoin moves up and down anytime. It's super volatile. So if we are to let Bitcoin be money in the future, the concept of it having a store of wealth will reduce because it's very, very volatile. Or store of value will not stand because it is very volatile. It moves anyhow. Just around 2019, 2020, Bitcoin was around $4,000, $5,000. Now it's like $110, $110,000. Just imagine, right? So it moves around or ups and down and the like, so it will not be able to. Yeah, so yeah, Bitcoin is a type of electronic money created in 2019 by mining. Bitcoin is created by decentralized users where they use their computer power to verify and process transactions. Although Bitcoin functions as a medium of exchange, it's unlikely to become the money of the future because it performs less well as a unit of account and a store value. Yes, so that's what I've been saying. Now, let's move to measuring money, right? So how do we measure money? And which particular assets can be called money, right? So money or measuring of money is more or less like monetary aggregate. What constitutes money? What is made up of money, right? So here we are going to talk about money supply, right? So money supply is also the same as monetary aggregate. Now, money supply is based on the kind of money or the amount of money in circulation. So we will be having the M1, which is the narrow money, right? What M1 constitutes is currencies, the money that we have. It also have travelers checks, and it also has demand deposit and other checkable. So what we do is that this is actually based on the concept of liquidity, how they can be converted easily into cash. So currencies are already in the cash form, we hold it and we have it. Travelers checks can be withdrawn easily even without demanding, like even alerting the bank. Right, so travelers check is more or less like a check that can be cashed out in a different kind of location. Right, demand deposit it's more or less like a deposit you've made and you can demand it or withdraw it anytime. And then other checkable one is any deposit that you can withdraw it anytime. And that is what constitutes the M1 type of money. Now the M2 has the M1 plus any other time deposit that you have to prompt the bank before you withdraw. Savings deposit as well, you have to prompt the bank before you withdraw. That is for other countries, but I'm not sure in Ghana you prompt the bank before you withdraw your deposit. Here, the Uber say you have. So, and also money market deposit account plus money market mutual fund shares. So in exams, if we are to in case define what M2 is, if the first question is what M1 is and you define M1 and the second question is what M2 is, you can do the M1 plus the other ones you are seeing here. But if in case, M1, they didn't ask you of what M1 is and they ask you straight what M2 is, what I would advise is that you define M1 as the currency plus traveler's check plus demand deposit plus other checkable deposit plus now you add the denominations at the smaller denomination, time deposit, savings deposit, and money market deposit accounts plus money market mutual fund. So this is how you are supposed, I think, or I suggest you answer it if in case, like if you are to be asked to do anything of a sort in Darby. Sorry, let me add there. All right, sorry for the inconvenience. All right, so this is what it entails in here. So that's resistance. All right, so this is the Federal Reserve Monetary Aggregate as at 18th August 2014. Right, so here, if you are given this table and they ask you for the total M1 in the system, then the total M1 in the system is what you are seeing down here, is the 2,776.7 billion here, as you are seeing, and then the total is going to be M1 plus M2. So M1 plus M2 is giving us 11,290.4, right? And that's what we are having. If in case in exams we are giving anything of a sort, they can give you traveler's check, demand deposit, and other checkable deposit, and they tell you to compute for the total M1, and meaning that you have to add all of them and then find the M1. But if in case they are to give you M2, you have been told to find M2. What it means is that you are supposed to what? Add the M1 plus the small denomination time deposit, savings deposit, and money market deposit account, and also money market mutual funds, and add all of them. That will be for M2. Note that M2 is not only small denomination deposit and those kind of stuff. No, M2 consists of M1 plus the other ones. Now, this entails what we have in here, but just that in Ghana, we don't have M3. We currently have M1, M2, and M2 plus, where M2 plus is M2 plus foreign currency deposits. So foreign currency deposits, right? So we have to look into that. So here, M1 is here. M2 will consist of M1 and other ones, and then M3 will consist of what? M1, M2, and then other ones as well. Now, M2 plus will also have M1, M2, and then what? Foreign currency deposit, right? Now, this is what we are actually looking for in this session. The Federal Reserve Monetary Aggregate. So M1 and M2, does it matter which measures money, which measure of money is considered? And M1 and M2 can move in, so M1 and M2 can move in different directions. So here, this is what is needed. So now it's up to the central bank to decide whether to increase M1, more of M1, or more of M2. So if the central bank wants people to have businesses, to create more businesses, to increase goods and services in the country, what they do is that they increase M1 in the system so that people will have more cash with them to do businesses. Now, if the central bank wants to reduce the amount of money in the system, what they do is that they rather increase M2, in the sense that the liquid kind of money will be less in the system, and then now inflation rate will also reduce. Now that is how they do it. So it is more or less like if the inflation rate is low, they increase more of M1. But when the inflation rate is high, if it's high, they reduce M1 and they increase more of M2. Right. So that is how the Federal Reserve normally does them at this thing, right? So conclusion is that the choice of monetary aggregate is important to policymakers. So the policymakers are the people who are going to decide on which one to actually look at. Now, we are saying that there are more than 4,000 of US dollar currency held per person in the United States. And it's surprisingly a large number. So now we are asking ourselves, where are all these dollars? Who is holding them? Are they criminals or they are foreigners? Right. So this is where we are saying that the M1 and M2 moves in different directions. There are times where M1 will be high, and there are times that M2 will be high, depending on what the government wants to do, right? So this can be an examinable question where they are going to ask you that in the situation of high inflation, right? Should the central bank increase more of M1 or M2 and explain? So this is where you are going to put in this knowledge there. Now, measuring monetary aggregate in Ghana. Monetary aggregate in Ghana is based on the liquidity of money, how close an item is to money. Right, that's what we explained up there. Financial assets are classified under the following monetary aggregate. So it can be M0, M1, M2, M3. Right, but here we look at what in Ghana M2 plus, no M3. So M0 is more or less like the monetary base, which consists of what? Currency in circulation plus reserves, right? So M1 will consist of what? Currency rates, non-bank, and then demand deposits, like what we did up there. Now, M2 will consist of M1 plus the savings deposit, the time deposit, and then certificates of deposit, right? With this one, you would need to prompt your bank before you what? You withdraw. You can't just easily convert them. Now, M2 plus is what? M2 plus foreign currency deposit, as we've explained up there already. So this is more or less like a recap. So this comes to the end of this session. Maybe this evening, I'll do a recording on this and then we talk about this. This is easy and then straightforward. We'll do some talks on it and then we are going to complete this by, I'm sure we are going to complete monetary theory by this week. Okay, and we start solving some questions as well. All right, I hope this was insightful. If it was, kindly give me a like on this video and also subscribe to the channel if you are new to this channel. Thank you very much for your time and then see you in this video. Bye.